Today, when I was recording a Bitcoin review for my private Telegram channel, I think I accidentally recorded one of the most important and best videos on my YouTube channel. Because this video isn't about another signal or about buy here, sell there, but about a mindset system, trading rules, and understanding when it's worth entering the market and when it's better to just wait. Before the main part of the video begins, I want to say a few important words. First of all, I want to thank Lev Mazur, the founder of the Quant Fury platform, where I do all my trading. I support Quant Fury not only because I truly believe this platform is the best for trading. There are thousands of financial instruments there, from cryptocurrencies to stocks, zero commissions and fees. A simple, straightforward logic for traders. But for me, it's also a personal story. Lev is the person who supported me during tough times and truly helped me become who I am today. So when I talk about Quant Fury, for me it's not just a trading platform, it's a place that's connected to most of my real experience in the market. I completely understand that many people might have a perfectly reasonable question. Vasya, why should we even listen to you? Maybe you're just another armchair analyst who talks nicely about the market. So let me show you my couch right away. Here's a photo of the couch I lie on. Sometimes I'm alone, sometimes with my cat, sometimes the cat is lying with me. It depends on how you look at it. The next photo is the living room in my house, which I recently bought and where my couch is. This is my house, not a rented backdrop for a pretty shot. Here is my car, the one I drive. Yes, it's not a Lamborghini and not a rented supercar for a day just for stories. It's just my hybrid Lexus. That's exactly what it is. I'm not trying to seem richer, more successful, or cooler than I really am, but I understand that for some people it's important to see who is speaking, what kind of environment the person lives in, what they look like, what they do, and how connected they are to reality rather than being detached from it. Not just saying smart words in front of a chart. Now, a brief word about my experience. I've been in trading since September 2017, and I started just like many of you from absolute zero. I watched some bloggers, listened to traders, read books, chats, channels, different people, listened to opinions, and tried to figure out what works and what doesn't. Then came my first trades, my first mistakes, my first earnings, and my first big losses. Over time, I reached a professional level, but believe me, I paid a very high price for it. I was making a lot of money. At first, it was hundreds of thousands, and then the amounts grew very large, reaching into the millions. At one point, I was the fourth largest trader by volume on Binance. But I'm also honest about the other side of things. When I was making hundreds of thousands, I was also losing hundreds of thousands. When I was making millions, I was also losing millions. And that's a very high price to pay for experience. That's exactly why, for me, trading today isn't about emotions, excitement, or the urge to grab profits from the market quickly. It's about rules. And the main principle I always repeat, don't rush and don't be greedy. I've personally experienced and come to understand a rule that seems completely incomprehensible to beginners. The main goal of a trader is not to make money. The main goal of a trader in the market is to survive. It's to preserve your capital so that every day you still have the opportunity to earn. Because most often a trader loses money not because the market is too complicated or unclear, but because he rushes, takes on too large a position, doesn't wait for a proper entry point, and jumps into the market where it would have been better to do nothing at all. In this video, I show a simple strategy that even beginners can use, but it will also be useful for experienced traders. There are just 4 tools at the core of this. 2 are publicly available. These are moving averages and simple candlestick logic, bullish and bearish engulfing patterns. The other 2 are my own indicators, mathematical targets and an overbought, oversold indicator. But the main thing here isn't even the indicators themselves. The main thing is the methodology, the approach, the logic behind decision making. This strategy helps answer 2 very important questions, and people often don't answer the second one because they don't even ask themselves that question. The first, where can you look for an entry point, where to buy or where to sell? The second, which is no less important, when you shouldn't enter the market. Because sometimes the best trade is the one you never opened at all. When the market doesn't provide a clear picture, it's better to just wait. I call this sitting on the fence. Don't buy, don't sell. Just observe and wait for a clearer situation. Until the end of May, access to the YouTube broadcast with my tools is absolutely open to everyone. You can watch, test, observe, compare with your own tools, and draw your own conclusions. Starting in June, access will be available only by paid subscription. The link to the broadcast will be in the description below this video. But even if you don't use my indicators, the logic of this approach can be useful for almost any trader. And an important disclaimer, this is by no means a financial recommendation. It's not a promise of profit. It's not a golden grail. It's a set of rules that helps remove chaos from your trading. It helps reduce the number of random trades, minimize risks, and better understand exactly what you are doing in the market here and now. I paid millions for this understanding. You are getting it for free. If you're ready not just to look at the chart but to understand it and act according to the rules, to follow discipline, then let's get started. Let's go. Hello again, it's 11:27. In Kiev, it's May 22nd, Friday, and Bitcoin is trading at $77,476. And once again, I will try to provide a description and explanation of how to use my indicators, and how this system of indicators, these so-called charts and Bitcoin broadcasts, helps you make well-informed decisions. Quite effectively, and there are actually two types of decisions. The first type is when to open trades, and the second type is when not to open them. In other words, it's very important to sometimes know when you shouldn't enter the market, yes, when the market is, well, let's say, in a state of uncertainty, and it could go either way. Let's start once again, step by step, with our most important indicators. Essentially, there are two, and there are also some additional hints in the form of moving averages and things like bullish or bearish engulfing patterns. So basically, you could say that we have two key indicators from me, although in reality there are more here. And two very useful and general analysis tools. Here is the very first key indicator coming directly from me. The red line under each chart, which indicates overbought or oversold conditions on the corresponding time frame. So, for example, right here where the cursor is, on the weekly candles, this indicator signals very strong overbought conditions and the risk of a decline. That's clear now. Accordingly, when the indicator is at the bottom, it means there is strong oversold pressure. Strong overbought conditions are not a guarantee of a decline. Strong oversold conditions are not a guarantee of growth. But it does indicate that in a strongly overbought market, it is very risky to open long positions or make purchases. And in a strongly oversold market, it is very risky to open short positions or make sales. But strong overbought conditions do not prevent further growth. They do not prohibit it, so to speak. They just make it less likely, and a decline becomes more likely. A decline, nor do strong oversold conditions prohibit a further decline. They just make that decline less likely, especially in cases where the neighboring timeframes are similar in size, in scale. In this case, weekly candles. So, which neighboring ones should we look at? Those are the monthly candles. That is, in fact, a time frame that is 4 times larger, because there are about 4 weekly candles in 1 month. And daily candles, that's a time frame that, let's say, is 7 times smaller, because there are 7 daily candles in 1 week. So, here we have contradictions regarding this indicator. Because strong oversold conditions on daily candles generally indicate that there are risks of growth. If so, we can say probably a higher probability that the instrument, in this case Bitcoin, will go up. And the monthly candles show exactly the same picture. There is strong oversold pressure and there is a break in this indicator. If you expand it, you can see that it was pointing down, but now it has turned upward. This is what I call a break. And here too, there is an indication that the growth may continue. And not only continue, but possibly it is just beginning. Accordingly, here on the weekly candles, despite the strong overbought condition, there is a discrepancy or contradiction with the neighboring timeframes. This means that, strictly speaking, it is not possible to make any clear decision here. However, if we look, for example, at the daily candles or the 12-hour ones, we see that this indicator is pointing upward. It has a positive dynamic, which generally indicates an upward movement. And here we recall another one of my indicators. These are the so-called mathematical targets. These are rectangles, either light turquoise or light green in color. These are growth targets, or yellow and light pink or simply pink. These are the targets for a decline. Light turquoise ones are strong growth targets. Light or simply yellow ones, these are strong targets for a decline. The term strong is rather conditional for a simple reason. Both types of targets are very likely to be reached. That is, about 90 to 95% of the time, over a distance of 1,000 candles on the relevant time frame, they are fulfilled. So for example, we take this target. Yes, here it is, the green one, and with about a 95% probability, maybe even higher, we will see Bitcoin in this area, $80,200, but 1,000 12-hour candles, if we divide that in half, that's 500 days. That's a very long time. But nevertheless, that's the situation as it is. As a rule, the target is reached much faster, but that's not a guarantee either. And so when we have an upward direction on this overbought, oversold indicator, moving from bottom to top, which indicates a positive upward trend in the price of the asset, and we have growth targets, then the two indicators reinforce each other. And at the very least, the probability that Bitcoin will reach this target, around 78,000, given the current price of 77,477, is quite high. And if we look at the higher time frame, it also generally points to growth because there is strong oversold pressure here, and this indicator on the daily time frame suggests that the chances of moving downward are significantly lower than the probability of moving upward. In this case, the 12-hour and daily candles appear to be quite consistent in terms of their indicators. Or rather, it's the time frames, not the indicators. The picture on these time frames is consistent and points upward. But if we look at the 4-hour chart relative to the 12-hour, we'll see that here, this overbought, oversold indicator is in a neutral state, but still shows a negative trend. At the same time, the last movement we saw here was bearish. Engulfing is the third tool we pay attention to. Yes, it's publicly available. That is, you can see on the candles that the green bullish candle was engulfed by a red bearish candle. Let me zoom in so you can see it. But here, there is also a nuance here that you need to pay attention to, and over time you will learn to do this. In this case, it is not a full-fledged bearish engulfing pattern, and here's why. Because this green candle did not update any local highs at all. It's a sideways candle, a flat candle. And we need to find the last candle that updated the high, the one that did so after, for example, a bullish engulfing pattern occurred. Only then do we have the right to talk about a reversal upward or downward. What do we see here? We see, look, here is an upward movement. Here is the last green candle that updated the local high. It was engulfed by two falling candles, after which we got a reversal. It seems so, but why only seems? Because firstly, this large red falling candle was not engulfed. We only tested its base, the opening point. Secondly, even if we consider that there was an upward movement here right now at this very moment, we are at risk of engulfing this growth candle, this relatively large one, which at least somehow fits the idea that some kind of local high was updated. So if we engulf it now, the probability that the downward movement will continue, at least down to the levels of $76,500, will increase significantly. For now, we can say that the last full-fledged structure was bearish. There was a bearish engulfing here. This is the candle that made that engulfing move. The red bearish candle was not engulfed, which means the entire movement remains. After it, we are looking at nothing more than a sideways trend. At the same time, note that we have a growth target that we haven't reached, but we also have negative dynamics on this overbought, oversold indicator, which means that buying this instrument is currently prohibited. So, they will only be allowed when, at the candle's close, we see either a reversal of this indicator from below upwards, or when we reach this area of strong oversold conditions. And at the same time, the same level of oversold or positive dynamics of this indicator should be maintained on higher time frames. And ideally on the lower neighboring time frame as well, in this case on the hourly candles. So what do we have at the moment? At the moment we have strong oversold conditions on the hourly candles, positive upward momentum on the 12-hour chart, despite the fact that our current candle is red, but it's not critically red, so that's not a problem. We have a forming one. For now, there is a growth target, a formed growth target, and both have not been reached yet. And we already have a neutral state on the 4-hour chart. So as soon as we see a reversal upward on the hourly time frame, and what will be the sign of a reversal? First of all, a break in this indicator. It must definitely be confirmed at the close of some candle. That is not just that it turned upward for a moment, but that it actually turned and remained in that state, looking upward until, well, this break happened after the next hourly candle closed. Until that happens, we say that the downward trend continues. That's the first point. The second point is that we need to see a bullish engulfing pattern, at least on the hourly candles. And in this case, we can only assume that the 4-hour chart coming out of the neutral zone might possibly turn upward. But the ideal scenario is when the 1-hour, 4-hour, and 12-hour charts are all oversold. And then on the 4-hour time frame, because the lower time frame, meaning the smaller hourly candles, are also oversold. And the higher time frame, the 12-hour candles, are also oversold. And the key base time frame, on which we base our trading decisions, is also oversold. In this case, it is fairly safe to open a long position. Right now, the situation suggests that yes, there is a chance for a reversal due to the oversold hourly candles, but so far there are no confirmations of a reversal here. There is a chance for a reversal due to the neutral state in terms of overbought and oversold conditions on the 4-hour candles, but for now, there is negative momentum here, and it doesn't look like this downward movement has stopped. And there is a chance, because of the positive momentum of this indicator, there are growth targets that haven't been reached yet, meaning there are prerequisites for growth. But for now, these are just prerequisites, which means trades should not be opened. Considering that the hourly candles are heavily oversold at the moment, we can say that here it makes sense to lock in your short positions, or at least move your stop closer to the current price, so that if the market reverses, you don't lose your profit or end up with a loss if you currently have open short positions. Because in principle, there are prerequisites for a reversal. Look, the 5-minute chart is already heavily oversold, and the hourly chart is oversold as well. Now we just have to wait for the 15-minute chart to enter oversold territory. So, for now, here and now, we can assume that the decline will continue. Most likely with a move toward this pink target on the 15-minute chart around the $77,000 level. But overall, judging by the hourly candles, the neutral state on the 4-hour chart, and the presence of growth targets, as well as the presence of growth targets on the 12-hour chart, and right now we're basically seeing a sideways movement. On the daily candles, there's strong oversold pressure. The picture looks like that, which, well, is more reminiscent of such a state. This typically precedes a strong upward movement, at least toward the area of the 200-day moving average. It's the orange one. Yes, that's $80,500, and at most, it's around $92,000. Because here we have the 300-day moving average passing through, because right here it passes through. Here on the weekly candles is the 50-week moving average, which we broke through from top to bottom and have not tested even once. So overall, the general trend, despite the strong overbought condition of the weekly candles, well, in my opinion, as far as my many years of professional analysis allow me to draw conclusions and judge, it is still directed toward that area. The 100-week moving average is at $87,000 to $88,000, and the 50-week moving average is in the range of $92,000 to $94,000. Now, once again, let me remind you of the 4 basic tools we have. The first tool is the overbought, oversold indicator. I have explained how to use it. The second tool. Rectangles are my indicators. Green and light turquoise ones are growth targets, while yellow and pink ones are targets for decline. The third tool. This is the fact of bearish or bullish engulfing patterns. Accordingly, a bearish engulfing is not a guarantee of a drop, but it greatly increases the chances of a decline. A bullish engulfing, when a green candle engulfs a red falling candle, is a fact that greatly increases the chances of growth. But here it is very important to understand that not every engulfing pattern is a quality bullish or bearish one. That is, just like in this case where the red candle engulfed the green rising candle, we cannot consider this engulfing as some kind of reversal pattern. Well, simply put, if we look at just these two candles where the cursor is on the 4-hour chart, because the green candle did not break any local highs, this engulfing is simply a movement within a sideways range, within a flat market. But when this specific green candle, take a look right here from May 21st at 3 a.m. Kyiv time, successfully set a brand new local high, and then was quickly engulfed by these two subsequent falling candles. So this kind of setup is what we call a full-fledged bearish engulfing, and strictly speaking, based on the candle structure here on the 4-hour chart, currently Bitcoin is in a bearish downward phase until we engulf and close above the candle that last set a significant local low point. The trend remains unchanged. And here we have eaten it up with the growth of green candles. And right here, right now, there's a somewhat controversial situation. Why? Because look, we have a candle here, which is also from May 21st, but at 3 o'clock, Kyiv time, which updated the low but closed with a green body. And the fact of such a candle, that is, it kind of engulfed itself in a way. Yes, in a sense, it is a reversal. Yes, that is a technical reversal. Why do I say that a candle which updates some local or global low and closes with a green body is a potential trend reversal? Because yes, it did update the low. In fact, it was a drop, but it closed with a green body, which means it essentially engulfed itself. It engulfed its own decline with a green growth body. That's it. This is the third tool, engulfing, bullish or bearish. And finally, the fourth tool, these are moving averages. So here I have the red one. That's the 100 period. The green one is the 50 period. The orange one is the 200 period. In this case, where the cursor is, this is the 200-hour moving average, yes, because these are hourly candles. And so when we see that the instrument is trading near the averages but below, say, all the moving averages, then we absolutely cannot talk about growth because the trend is such that the current quotes are lower than the average over the last 50, 100, and 200 periods. But when we see that the price has consolidated above all the moving averages, then in this case we have the right to say that the chances for growth increase sharply. The chances for growth also increase when the price has moved away by a very large distance from the moving averages. Well, I probably can't show you such an example here because, well, no, there just isn't such a situation here. But let's open up some hourly candles to full screen and find such a situation. So look here, the green 50-hour moving average, the price. It tested it and then moves away by a large distance. Right here. And here a bunch of signals appear. It doesn't matter what they indicate, but when they are below the candles, they point to potential growth. And what happens next? The gap from the 50-hour is large. From the 100-hour and from the 200-hour, it's very large. The price returns again to the 50-hour moving average. So, when we are at a large distance from all the moving averages, even from the closest one, the chances for growth increase here. But when we are here, for example, right here, we are below all the moving averages, but very close to them. To the nearest one, on the contrary, the chances increase that the downward trend will continue. And the same works in the opposite direction. That is, when we had an upward trend, well, let's show something like that. Look here. Well, here, yes, look. We have an upward trend, we drop down to the moving average, and since this is still an upward trend, as they say, the trend is your friend, it always tends to continue. Well, there's a higher chance it will continue rather than reverse. That's just how the market works. And when we approach the nearest moving average, if we don't break through it from above, there's a greater chance that we'll get a bounce upward, which is exactly what happens. So at this point, as long as we are above the moving averages in an uptrend, you should never short under any circumstances. Accordingly, at this point, look, in a downtrend, we had a convergence downward. Right here and here, as long as we are below all the moving averages, even the first local attempts to break through are very risky for buyers. You should only buy either when there is a significant gap from the moving averages or after a breakout with confirmation. What is a breakout with confirmation? Look, there were many attempts to break through here, then finally there was a clear breakout, then it was tested, closed with a green candle, and this can be considered a breakout with confirmation. Why? Because we broke through the moving average from below, tested it by touching it with the candle's wick from above, closed with a green candle, which means the chances of an upward movement have sharply increased. What we have here and now is a situation of uncertainty, right? We are not below all the moving averages. Yes, right now, after once again breaking through the 100-hour moving average, the red one, we are now testing it from above. Yes, we have strong oversold conditions, but so far there is no confirmation that the market will continue to move upward. The confirmation will be, first, a bullish engulfing pattern here on the hourly time frame. Second, a reversal of the overbought, oversold indicator from below upwards. And third, consolidation, at least above the 50-hour moving average, and ideally above the 200-hour moving average. That's basically what it's called. I explained it as if to a 5-year-old. As Einstein said, if you can't explain something to a 6-year-old, then it means you don't really understand it yourself. I think that if a child is smart enough, then even at 6 years old, with enough attentiveness and a desire to understand, he would understand this explanation. Once again, let's reinforce the first indicator, overbought and oversold. When it's at the top, we don't buy. When it's at the bottom, we don't sell. That's what you shouldn't do. Don't buy here and don't sell here. Second, when we have oversold conditions confirmed across several consecutive time frames, it is fairly safe to open a long position, especially if there are growth targets on one or more of these 3 time frames, or if there is already a formed bullish engulfing pattern on any of the 3 time frames if we see that all 3 are oversold. If we see on the central time frame, preferably on the central one, or at least on the lower one, a reversal of the indicator from bottom to top. The very fact of being oversold is not a guarantee of growth, just as being overbought is not a guarantee of a decline. Secondly, the indicator of mathematical targets for rectangles is just a hint, a slight priority in one direction or another, but again, not a guarantee. We consider everything in combination. If there are growth targets, this indicates that there is a higher chance that these targets will be reached and the price will rise. But this is not a guarantee. We need to look at other tools as well. Third, a bullish engulfing pattern suggests that the trend priority has most likely shifted to an upward movement. A bearish engulfing pattern suggests that the trend priority has most likely shifted to a downward movement. But we only call it a bullish or bearish engulfing pattern if it engulfs a candle of growth or decline that has updated a significant local maximum or local minimum. If it's a sideways candle that hasn't updated, if it's a candle that hasn't updated the maximum and we engulf it, then it's not a bearish engulfing pattern. If it's a sideways candle that hasn't updated the local minimum and we engulf it with a green candle, then it's not a bullish engulfing pattern. Because what is fundamentally important is the engulfing of a candle that has actually updated the minimum or maximum, the third or even fourth point. So, moving averages. If the price consolidates and breaks through all the moving averages from below upwards, the priority is up. If it moves significantly above all the moving averages, the priority shifts to down. If the price breaks through all the moving averages but stays close to them, breaking from above downwards, the priority is down. If the price moves significantly away from all the moving averages to the downside, the priority is up. And I emphasize we consider all these tools together, taking into account the neighboring time frames. I've actually just explained to you a trading methodology based solely on these 8 broadcast charts. You don't need anything else. You don't need Donald Trump's Twitter. You don't need any news feeds. You don't need interest rates or the Federal Reserve's key rates. Everything you need is here, at least for trading Bitcoin. The situation is a bit different in the stock market. There, things are much more serious. Fundamental factors have a significant impact on the market there. But in the crypto market, the situation is exactly as I described. And moreover, Bitcoin is the trendsetter. By knowing how Bitcoin will behave, you can use the same tools, but always with reference to Bitcoin when dealing with other cryptocurrency pairs. Because if you know that Bitcoin is signaling serious downside risks, then obviously it's better not to go long or buy altcoins. If you know that Bitcoin is set for growth, then you can use the same methodology, analyze the chart of the corresponding altcoin, and if the appropriate structures are present, consider buying just as I described in this video. This is probably the best video I've recorded in many months, and maybe even in several years. Today I was inspired, I had the desire, and it turned out really well. Subscribe to the channel if you managed to, if you wanted to, if you really wanted to, right? Watch this video until the end, because I will be posting it not only on the Russian language channel, but also on my channels in other languages. Hugs and kisses, trade carefully, don't rush. Know when you shouldn't enter the market, don't enter. That's when the market doesn't have a consistent picture across neighboring time frames. For example, when the 4-hour chart suggests a decline, the 12-hour chart suggests growth, and the daily chart suggests a decline. In such a situation, you shouldn't open any trades. Just wait for your moment. A patient person will eventually find the right entry point and will earn enough money as long as they don't take on excessive risks. That's the second task. The motto of our channel, of all my channels, is don't rush and don't be greedy, and everything will go well for you, both in life and in trading. Goodbye.